Your insurance agent is not on your side, at least not the way you think. In 2026, the average loyal insurance customer is overpaying by the $1,100 a year without knowing it. In this video, I expose 7 secrets the insurance industry hopes you never find out, from hidden loyalty penalties to the commission structures that influence what policy you're sold. Watch before your next renewal. Your insurance agent just sent you a renewal notice. The premium went up again. You called to ask why, they gave you a vague answer about industry rates, and you paid it. Here's what they didn't tell you. You are almost certainly overpaying by over $1,000 a year. Not because you're uninsured, not because you had a claim, but because of 7 specific things your agent knows and isn't telling you. Stay until secret number 4, because that one might actually shock you. Most people have no idea it exists. Welcome back. If this is your first time here, this channel is about giving you the financial information the industry hopes you never find. Today we're going inside the insurance business. I'm going to tell you exactly how your agent gets paid, exactly how carriers price your renewal, and exactly what you can do in the next 30 days to stop the bleeding. Let's get into it. Secret number 1. Your loyalty is costing you over $2,000 every single year. In most industries, loyalty earns you a discount. In the insurance industry, loyalty earns you a target on your back. It's called price optimization, and here's exactly how it works. Insurance carriers run sophisticated algorithms on every customer in their book. The algorithm asks one question: how likely is this person to shop around? If the answer is not very likely, then if you've been with the same carrier for 3 or more years and have never gotten a competing quote, the algorithm marks you as a low churn customer, and then it raises your rate incrementally. Every renewal cycle, typically 3 to 8% per year, not because your risk changed, not because you filed a claim, because the algorithm knows you'll probably just pay it. A 2026 analysis of 2,400 families found that customers who stayed with the same auto and home insurance carriers for 8 years paid an average of $6,400 more than customers who switched every 2 to 3 years. JD Power data confirms the average loyal household is overpaying by the $1,200 per year today. Your agent knows this. They won't tell you, because if you switch, they lose the renewal commission. Secret number 2, your agent may not have access to the best rates, and they'll never tell you that. There are 2 types of insurance agents: captive and independent. A captive agent, think State Farm, Allstate, Farmers, works for one company. They can only sell you that company's products. When you call a captive agent and ask if they have the best rate, the honest answer is, I have the best rate I can offer you from this one carrier. But that's rarely how it's framed. Independent agents have access to multiple carriers, sometimes 10, sometimes 30 or more. But even independent agents don't have access to every carrier. Many operate through aggregators, and their options are limited to the carriers in their network. The result, you might be paying $1,800 a year for coverage that a carrier your agent doesn't have access to would offer for $1,200. The agent isn't lying to you. They genuinely can't offer you what they don't have, but they also won't tell you to go look elsewhere, because that ends the sale. Secret number 3. The policy your agent recommends is influenced by how much commission they earn on it. Insurance agents typically earn 10 to 15% commission on the policies they sell. That sounds standard. But here's the part they don't volunteer. Different products within the same carrier pay different commission rates, and different carriers pay different bonuses. Life insurance is the most dramatic example. Term life pays agents 50 to 80% of the first-year premium in commission. Whole life pays 80 to 120% of the first-year premium. So when an agent recommends a whole life policy over a much cheaper term life policy, there is a financial incentive baked into that recommendation. Not always. Many agents genuinely believe in what they sell. But the incentive exists, and it is substantial, and it is never disclosed unless you specifically ask. Carriers also run contingency bonus programs, additional payouts to agents whose books of business perform well or hit volume thresholds. An agent who is close to a bonus threshold at the end of the quarter may be more motivated to close your policy quickly than to make sure it's the perfect fit. Secret number 4. And this is the one most people have genuinely never heard of. If you call your insurance agent and ask a hypothetical question, "Hey, is water damage from a burst pipe covered?" That call may be logged as a zero-pay inquiry on your CLUE report. CLUE stands for Comprehensive Loss Underwriting Exchange. It's the database insurers use to see your claims history when you apply for new coverage or renew. In 2026, automated systems at some carriers scrape inquiry logs and flag policyholders who ask frequent questions about coverage as high maintenance, statistically more likely to file future claims. The result? Your premium goes up, or you get declined by a new carrier because of a question you asked and a claim you never filed and money you never received. This is not hypothetical. Regulatory agencies in multiple states have investigated this practice. It is legal in most states. Secret number 5. The annual review your agent sends you is not a review. It's a billing notice with a cover letter. A real insurance review means re-quoting your coverage across multiple carriers, reviewing your life for changes that affect your coverage needs, identifying gaps created by things like home renovations, new vehicles, starting a home business or adding family members, and benchmarking your premiums against similar customers in your area. What most agents actually send you is a PDF showing next year's premium, a brief note saying "let us know if anything has changed," and a link to pay online. That is a renewal notice. It is not a review. Your life has changed since you bought that policy. Your home is worth more. Your income is different. You may have new risks your current coverage doesn't address. None of that gets addressed if nobody is looking. Secret number 6. You may be in the wrong pricing tier, and your agent has no incentive to correct it. Every major insurer places customers into rating tiers based on risk factors: preferred, standard, or non-standard. The tier you were placed in when you first got the policy determines a significant portion of your premium. Here's the problem. The risk factors that determined your tier may have changed. A speeding ticket from 4 years ago may have aged off your record. Your credit score may have improved significantly. You may have made home improvements that reduce your risk profile. But unless someone proactively reviews your tier classification and initiates a reclassification, your policy simply renews at the same tier. Industry data suggests customers in the wrong tier overpay by 15 to 30% annually, sometimes for years. Your agent benefits from the renewal commission regardless of which tier you're in. There's no financial upside for them to do the work of getting you reclassified into a tier with a lower premium. Secret number 7. Price optimization doesn't just affect the market. It targets you as an individual. We talked about the loyalty penalty in Secret 1, but what most people don't realize is that this isn't a general policy applied to all long-term customers equally. It's individual. The algorithm builds a behavioral profile on you specifically. Your payment history, your responsiveness to renewal notices, your claim frequency, your credit behavior, even in some states your occupation, your education level, and your home ownership status. From that profile, it predicts exactly how much of a premium increase you will tolerate before you start shopping. Then it charges you precisely that amount. Not $1 more, because that would make you leave. Not $1 less, because that would leave revenue on the table. This is not theoretical. State insurance commissioners in California, Maryland, and Florida have investigated or taken action against specific carriers for price optimization practices. The practice is legal in most states and actively in use at major carriers right now. If this video saved you money or changed how you think about your insurance, do me one favor, subscribe. I put out a video like this every single week, the financial information the industry doesn't want you to have. Leave a comment right now. Which one of these 7 secrets caught you off guard? I read every comment. Next video, I'm breaking down the 5 types of insurance you're almost certainly overpaying for and exactly how to cut the premium without cutting the protection. You don't want to miss that one. I'll see you there.